This video is about tax equity. Tax equity investment. It's a form of investment, and it's a form of structuring projects primarily used in renewable projects in the U.S. Now, I've debated on whether making this thing or not. It's losing relevance because of the changes in the tax law, and whether anybody's ever going to pay taxes or not is a different issue. And however, this here's why I'm making this. This subject has extremely tricky programming issues related to cash flow waterfalls and distributions. I take that back. Not extremely tricky, but difficult. And it also has subjects related to the philosophy of modeling. How detailed do you really have to get? What should you focus on? How should you structure your outputs? Now, there are some real painful things here. Here's some of the things. What I did is, I'm working on this for a friend of mine in Holland, and we're trying to go through these terms: deficit restoration obligation, suspended loss outside capital account, section 731 adjustment, stop loss reduction, absorption, excess cash distributions, blah blah blah. What crazy terms! And before I get any further, let me just tell you, I'm a student here, not a teacher. If I'm really made an effort to use both public information and models that I've seen. Now, if you really beg, I'll give you some practical models. Some people ask for them. I've kind of tried to keep a database of models. It's not as good as what banks have, but I've got quite a few. I'm not a tax accountant or a lawyer, so I'm just trying to show you how you can model some of the tricky things, and I'm going to use some of these actual models I just talked about. If you're going to fall asleep, turn this stupid video off, of course. Now this here, I've got into arguments with people about this one. The lawyers must just love this. They can charge a bunch of fees, and it's so complicated to try to understand it. And what about tax accountants and investment bankers? It's so complicated. They love this, and Harvard students can tell people how smart they are. But when you really take a step back, it's kind of crazy. So I'm going to demonstrate. I'm really using this video. Even if you have zero interest in this, kind of the little waterfall and allocation techniques are probably worthwhile. I've done this a couple of other times. And then they get complicated because you've really got to understand. Well, not understand, but go through some accounting, and there are constraints on the taxes. That's going to be a second video. So, kind of have said this. I'm going to focus on some of the more complicated things. Here are my sources, some articles. I've looked at a bunch of articles, actual models, and all this. Okay, here's a little bit of philosophy. I started to try to make these models. I said, all I have to do is kind of work through actual models and then go through and re-engineer the models, or what you call this, go backwards and figure out what they did. But if you don't understand the basics of this and why they occur and what you're really trying to do and some of the economics, I've learned from this that it's not worth it. So here's the structure. Before we get in the model, let me go through some structuring aspects. There are two investors. There is a project company that doesn't pay tax, a partnership, and it's funded by two investors. I call that the tax equity investor and the sponsor. That's the first thing we want to know. And some tax equity investor here, I've used some quotes, they could put in 40 to 70%, and they usually kind of wait to put their investment in. Now, the reason this is important is because the U.S. government, at least before, offered the enormous kind of subsidies called investment tax credit. It's not a tax deduction. You just get a reduction. If you're going to pay 1,000 in taxes, and you have 900 of investment tax credit. You fill out all your tax forms and all that stuff, and you have your tax bill of that says it was 1,000, and then you have investment tax credit, and it just reduces your taxes then to 100. And there's something called a production tax credit, which is it's not the same, but it's also a tax credit, which says if you produce some amount of power from a renewable project, like a wind project it's really used for, then you can take multiply that power by a certain number, and you can get a tax credit again. Not a tax deduction, a tax credit. And most of these things, there's so many taxes built into these things, that benefits, that they can't pay enough, and well, I'll get back to how the investment tax credit, some people pay 10% more, basically, than the tax credit, okay? So here's the basic thing. There is a partnership set up. I almost should make a diagram, but I didn't. Okay, whatever. That the partnership has some EBITDA. It has some cash flow before taxes. And then you allocate that cash flow to two of the investors you have, this tax equity and the developer. You allocate the cash, but then you allocate the income, not the cash. Income is always just, to get income, you need depreciation. And you allocate the income on a different way that you allocate the tax. That's everything. That's how these things get set up, okay? And so once again, the partnership company. There's a company. You draw a little circle. They don't pay taxes. But the depreciation and these production tax credits and all that stuff, they can be, used by these different partnerships. And then here's where it gets a little tricky. There are these things called the flips around, and who gets what share of both the income and who gets what share of the cash flow. You just have to understand there's cash flow and there's income. Those are two different things, and they allocated to two different investors, so we got a kind of matrix, and they get allocated at different percentages at different times. So here's an example. There's this thing called a yield-based structure, where income goes to this tax investor, this tax equity investor, until they reach a target yield. Now, that's a target IRR. You should be really careful. Because people mix up the term yield and IRR just a little bit. After the target IRR is reached, then the tax investor, instead of getting 99% of the income, which was a really income deduction, then they get only 5%. And there are all these esoteric kind of tax rules that says you can't allocate 100%, and they have to have an economic interest in the project, blah, blah, blah. And we're going to go through some of that later here. Now, I think this is just the worst. I really do. And this is where I get into arguments. People who love the complexity and love their fees and all that say it's great. But if you think about it, this yield it's just a cash flow sweep. It's just like a cash flow sweep for subordinated debt with capitalized interest. And it's as if it's not really subordinated debt, it's debt. Imagine a cash flow sweep where the bank gets all the money, or 99%, all the money until you reach a certain level, and then after that, the investor gets the money. That's an amazingly safe loan, And if they're structured like that, where you kind of guaranteed a certain amount of money, then why should you get these kind of interest rates? You can get about 2 to 4% a loan. They're getting 6, 7, 8, 9%. Now, not only are they getting that much money, and you really have to understand what risks they're really taking, not only because they get kind of all the money until it flips around, but it might not be that extreme, by the way. It might not be that extreme, but they get it after tax. They don't have to pay taxes on the income because that's the whole basis of it. So once you do all of that, they're incredibly high returns, really. Okay? Now, I can only have one explanation, is that these people who actually pay some taxes and need these tax benefits, there are just a few of them, and they kind of have the power, whatever, political monopoly power. Okay? And that, what the whole thing does is says, well, if these kind of loans, you call them tax equity, they're really loans, but if these get such a high interest rate, they're getting the benefit. Okay, enough of the comment on all of this. And then the real question, there are some questions. I have to be fair, and I have to be a little objective, because you might not get all the tax benefits. There are tax risks you take, which are the horrible part of kind of modeling this. Okay, so let's look at the kind of modeling. First, there are two types of flips. One is when it's just a time-based flip. When you just say, okay, we're getting all the money first as the tax investor until a certain amount of time runs out, and then you get it later on. All you have to do there is put a little switch in, a little switch that says, oh, okay, here's the pre-flip and here's the after, the flip later on. We're just going to flip it around. And then there's a yield-based flip, which is like this thing I just talked about. This is this capitalized interest, and it's like setting up a debt account. Now that's worth seeing how things work. So I'm going to show you a first example where there's no complicated flipping of 90% and then 10% and blah blah blah. All goes to the first one, and then all goes to the second one. So you have two investors, the tax investor and the other investor, and they get some money and it all flips around. And here is the trick. You want to use something called a tracking account, this kind of tracking account. Now, I think to demonstrate some of this, what I've tried to do is put together a file. And I have a simple case. So we have, and this demonstrates a structure of any model. We start with operating cash flow and see what's the IRR. So we spent 2,050, then we get all these tax benefits, and then we get less. And I hope I press Control-Alt-C. Oh, I got to open the generic macros and initialize them. I hope you see that all you have to do, you don't have to do anything fancy here. All you have to do is have this generic macros open. Control-Alt-C, and then you can include the true-false. You can make it a different color. Right now I have kind of a yellow color or something, and then you can color the sheet. Okay? That's what I did. That's how you get the various things. Now, in this case, we put a flip rate of 7% in, and the big trick is to set up this account, this capital tracking account, whatever. I made that name up just to make a more arcane, idiotic kind of thing. And then you put an opening balance, and then you add the interest to this. That's why I said it's kind of like sub-debt. And then this is what you get your payments, and you have to go downstairs to the cash flow to get those payments. And then you put a closing balance, and when this thing goes to zero, the flip has occurred, and you have to kind of figure out who gets the remaining cash flow. And then you can say, okay, well, here's the IRR for the first investor, which is just the flip rate, and then the other sponsor. So the way to understand the modeling is just to go through and do this. And let's do this. So anytime you have an opening balance and a closing balance, you better, in this case, I'm going to press over here, Alt-WFF. And here's what I'm trying to do with this. I am trying to give you some exercises, because I actually had one person who said, I want to get your badge. I want to do some exercises. I actually want to do this. You start with the first account, the tax equity account, and then you make the opening balance equal the closing balance. And then you take this opening balance and you multiply it by the interest rate, just like we do any kind of interest rate. And then the dividends, they come from downstairs in the cash flow statement. And then you put the closing balance, and I used a positive number convention, and have the closing balance. And then we put in our cash flow from our operating analysis. And then we say, okay, this is the only little bit of difficult account. It's a minimum function in a cash flow waterfall. Minimum or lookup should be your two favorite functions. No index match. No. Minimum or lookup. And then we say, well, let's take the minimum of the cash flow or the opening balance plus the interest. That's what I keep forgetting kind of sometimes. That's the big deal. That is the big deal. And then what's left over goes to the second sponsor. And then when we have our any kind of IRR, we better put a minus on the investor, and then we put a plus on how much they get from the cash flow. And then the sponsor has the same thing, a minus on their investment and a plus on their remaining cash flow. And then we just select all of these, since generic macros is open. Shift, Control R, Shift, Control R. Didn't work perfectly because of that little stupid thing. But don't worry, that because of this, it said, I'm going to stop here. So I have to select this and press Shift, Control R one more time. And then I can compute the IRRs. Okay, so that I'm going to leave this blank so you can do this yourself. Okay, there we go, and that's it. And now let's go to the kind of next exercise. So in my new kind of philosophy, I'm trying to explain things instead of just doing a little Excel. In this case, we have two investors. And we give, which we did last case, but this time we give 90%, not 100%, so we leave some over for the second investor, and we go back and forth. Now, you could say, no. This is not so safe. It's not like a pure cash flow sweep because we only get a 90% cash flow sweep, so that's fair. What you really should do is compare this equity investor to kind of a cash flow sweep, and let's do that one. And then, so in this case, I said, okay, well, here's our allocation. We have some cash flows, the same sort of cash flows, the same sources and uses. That's our first step always, a same tracking account. But this time we only get 90%. So we have a little bit of a different minimum function. And then I did a calculation. I'm going to do it differently in the one I'm going to show you. I'm going to say, well, take this number. No, I'm going to do it in our exercise. Okay. I hope I have this one. Do I have... Oh, no, this has two different cash flows. So I'm going to do the whole thing. Excuse me for this. Now we have two cash flows, operating cash flow and tax cash flow. And we have... two cash flows and a flip structure. Excuse me for that. I thought I'm going to maybe have to look at the structure of the little exercises, but don't worry. If you have two cash flows, let me just introduce it, okay? You have two cash flows, and some of it might be generated by EBITDA, some by ITCs, and this PTC, investment tax credit, production tax credit. You need to use a minimum function, and then you have to be really careful with the minimum function. You have to kind of put a cash flow. This minimum cash flow, the first one is simple, but the second one, you have to count for the last one to make sure this capital account that I'm talking about doesn't go a negative. Let me demonstrate that. Let me try to demonstrate that one. Okay, so first thing, I'm going to put in, this time I said, well, and this is, you can say, well, now the tax equity investor is getting a little more risk because they're not getting all of the cash flow. So maybe I was going a little too far on some of my comments. I'm going to put minimum, and then we're going to, just the same way, we're going and you know what I'm going to do here? I'm going to delete these lines in the tax equity account too. And I'm going to even color them in yellow. So when I have set up some of these things, I have tried to I want to make a course, not in easy modeling, not some Wall Street training crap. I want you to do something a little trickier. So we put minimum, and we take the cash flow, but this time you multiply it inside the minimum. This percent cannot be outside of it. It's got to be inside it. It kind of makes sense when you look at it. And then we take this plus the yield, just like we did before. Okay? And that's it. Shift Control R. Now, on this one, we do the same thing. We take the opening balance, multiply by this. This is like capitalized interest. That's the way I think of it. And then, here's the trick. Let's put this. I'm going to put this as 90% for just a minute. Now, if we put in this one that we get all the operating cash flows, okay? All right. I'm going to also make the tax equity only 500 for just a minute. Then it goes down to 0. Now, the big question is, what happens in this year when it actually goes down to 0? Now, you can see, to really evaluate the risk, and to evaluate the risk against something, a similar kind of loan, where you'd really have to think about what's the probability of default and all this, and what interest rate we really need for taking those risks. That's the interesting part, and it gets lost with all these horrible details. But we need to know in this year, how much was this pre-flip and post-flip, pre-flip and post-flip in this very, very last year. So what you do is you can take this number, which is the actual amount that's constrained by the minimum, and divide that by the total cash flow up here, and multiply that by this thing. Okay? And that gives us a percentage. So in this percentage, only 28% of this period was the pre-flip year. You can do this with any kind of thing. This has so far nothing to do with all this esoteric tax stuff. And then the other person gets this total cash flow. They only get 10% of it. And then we have to multiply it by how much was the pre-flip periods, because after the flip occurs, you get different amounts. So then you can take the difference. This is how much is left over for the second one. And notice now we apply different percentages to this cash flow over here. And then we take this. Now it's easy. We just take this cash flow, multiply it by how much you get after the flip, and take this cash flow and make sure, of course, those equal to 100%. And then we can do exactly the same with the post cash flow. Now, I'm going to put this back up to 1,100. How's that? Okay. And now we never flip now because and I'm going to put this down to 10%, perhaps. It doesn't really matter what do you put in. Then we have some tax cash flow. And we have two different cash flows. And I said, well, these tax cash flows are related to the depreciation. They come early on. And you take this tax cash flow and you put a minimum function again in. But this is where it gets a tiny little bit trickier, because you take this minimum function and then you take it from the opening balance plus the accrued interest again, but this time minus the thing that occurred upstairs in the previous waterfall. That is the big trick. It took me a long time to get this. Maybe it's totally obvious to you. And then you can do the same thing. Let's review what we did. We take this one divided by this one times the percentage, and we get this 100%. And then for the second one, we take the total tax cash flow. These people probably can't even use it, the tax benefits. And then we see how much is left over, the total amount minus what you've paid in the first two. Let's stop here, and let's Shift Control R it. Uh-oh. I better put a little, we better put a little if statement, if G29, we put that in. That's how simple. And then you get a remainder. And then you take this remainder and multiply it by the first percentage, and you take this number and multiply it by the second percentage. So we've done the thing twice, and the biggest thing was this minimum function and getting these kind of percentages right. Okay, and then you can, now I just added up all the cash flows. This is the cash flow, actually this is just the, excuse me. Excuse me, I didn't do one thing. Oh no. We attach this to the second part of the cash flow waterfall. And you attach this to the tax cash flow pre-flip. And you put it in, and then, you're flipping in just a year. If this was 10%, oops, I meant to be 10%, then 20%. It still flips in exactly the same year. Let's stop that. Okay, if this was only 60%, then it never flips around. So you can kind of see just how it works. And that's the first step. If it's 70%, it flips around. If it's our 99%, it flips at a different rate. If we have none of our operating cash flow, let's put 1% in, excuse me, then it didn't make much of a difference because they had enough to get everything back from the tax investor. All right, and right now, it looks like I just put in the pre-flip cash flows in here. I should have also, and that's really the good test, because I should have also added the post-flip cash flows here. And we could have some post-flip cash flows to which we do, to the tax equity investor. I left the tax equity investor way too high on this one. So now, let's make this one 95%. That's the way it would really work, and this is 1 minus this one. I don't know what I was doing there. And then you can kind of see who gets the IRR, and that's my complaint. If these people are getting a much higher IRR than the interest rates, and they're basically taking a loan because they get all the first cash flows, what's going on? Now, I'm going to do something called a suspended loss, and I'm going to do some more. But I'm going to stop this video, basically. The only thing I'm going to talk about is this time-based flip, which I kind of didn't do. I showed you how it'll work. You just put a little switch, and don't do something which, now this is my new yelling, don't put all those switches in a separate page. That destroys the transparency of a model. Put the switches where you're going to use them. Transparency. Enough. I got to calm down. Okay. And then you just put these switches in, and they have something called a preferred distribution, and then you kind of just take and allocate the tax and the EBITDA. It's a lot easier. There are no minimum functions in any of this stuff. Okay. And but here, they have something called a preferred distribution. It looks like it's not a big deal. Preferred 2% on the pre-tax yield. But most markets count the investment tax credit as part of the tax. So here's kind of how it works in a real simplistic kind of way. Let's say that you have a 30% investment tax credit. That's just a tax credit. No fancy deductions, nothing complicated. It just wipes out your tax liability if you have some. And they have this thing called a contribution ratio. 1.28 would say, I'm going to contribute 28% more than the ITC. Why they put that? And then they have this yield of 2%. Now let's look at it. The ITC has never really contributed. You basically make your contribution, not maybe exactly the same date, but pretty close to the date you're going to get the ITC. So let's say you put in, let's say you have 100 cost, and that means you get the plant, it costs 100. That means you get 30% IDC. That means that 38%, 30 times 1.2, which is 38.4, 38.4 of the 100% goes into the investment. But your contribution, the money you really take out of your pocket, is 8.4. Now, if you got 2% not on your 8.4 real contribution, you get 2% on the 38, which is 7.68. I should be using a little arrow. That's 7.68. That's like a 9.4% yield. You get that yield, plus you get all the, tax benefits on top of that. You get all the, tax depreciation on top of that. So even if you lose all the tax benefits, you're making 9.4%. Amazing returns to the tax investors. And that means that the cost of renewables doesn't really go down because of this, because the tax investors are taking it out. And so that's about as simple as economics is. Now, what I'm going to do is talk about the horrible stuff. I did the easy stuff, and I've kind of done this in videos before, but now what I haven't done is all these esoteric and arcane rules about capital constraints. Now, if you watched the last one, fine. That applies to kind of just modeling. This next one, I'm going to still go through it because it's got some philosophical issues. But of course, I'm going to stop the video now because this has been 30 minutes of torture already.